In this class today, we are going to discuss and learn about the fair value gap, commonly known as the FVG. There are two types of FVGs. One is a bullish fair value gap, and the next is the bearish fair value gap. Okay, so we have the bullish FVG and we have the bearish FVG. Okay, so with very simple illustrations, I am going to show you what is a bullish fair value gap and what is a bearish fair value gap. Okay, so a bullish fair value gap happens in an uptrend, okay, while a bearish fair value gap mostly happens on a downtrend. Okay, so a bullish fair value gap is formed by three candles, all right, all by three candles. So here we have a bullish candle. Okay, we have the first bullish candle followed by another bullish candle. Okay, then followed by another bullish candle. Okay, so this is the first candle, this is the second candle, and this one is the third candle. Okay, so in this case we are saying that a bullish fair value gap is formed by the gap between the high of the first candle and the low of the third candle. So in our case, this now is our bullish fair value gap. Okay, what we are saying is it is formed, this fair value gap is formed by the first candle's high. It is formed by the first candle's high and the third candle's low. Okay, so it is formed by this low and this high. Okay, that is what forms a bullish fair value gap. What about the bearish fair value gap? A bearish fair value gap is formed by three bearish candles. All right, so for example, we may have this as our first bearish candle, followed by another strong bearish candle, and then followed by another bearish candle. Okay, so a bearish FVG is formed by the low of the first candle, okay, and the high of the third candle. So in our case, this is our first candle, this is our second candle, and this one is our third candle. Okay, so this one is now what we call the bearish FVG. Okay, so here we are saying it is formed, this gap, the bearish FVG, is formed by the third candle's high, this one, the third candle's high, okay, the third candle's high and the first candle's low. All right, so in just simple terms, what we are really saying is that this is an illustration of a bullish fair value gap and this is an illustration of a bearish fair value gap. Remember, a fair value gap on a downtrend, we have the bearish. On an uptrend, we have the bullish. Okay, the bullish fair value gap. Remember, the concept of the fair value gap is defined using different terminologies among price action traders. Okay, so some may call it an imbalance. Okay, you may find someone calling an FVG as an imbalance. Okay, you may find some other traders calling it an inefficiency. Okay, it can also be called an inefficiency. Okay, you may find other traders calling it a liquidity void. Okay, you may find other traders calling it a liquidity void. All these three names they describe a fair value gap. Okay, and so a fair value gap is a concept that is rooted in the belief that the market will naturally tend to correct itself. Okay, so in a bullish fair value gap, we tend to think that the market will come, tap into the bullish fair value gap, and continue in an uptrend. Okay, in the case of a bearish fair value gap, we believe that the market will come back, retest that area which is the bearish fair value gap, and continue on a downtrend. Okay, so fair value gaps provide a very unique advantage by revealing the entry points. Okay, by revealing these entry points in the markets, and also they may also reveal the exit points in the market. Okay, good. So we have just noted that the fair value gap occurs by leaving a gap between the first candle's wick and the third candle's wick. Okay, but I know that the burning question in this class right now is that how can we correctly identify a fair value gap on a live price chart? Okay, good. So the first step is always to identify a substantial candle. Okay, good. So the first step is always to identify a substantial candle, and this always is this candle. Okay, the second candle is always the substantial candle. Okay, so this candlestick should have a significant, okay, body to wick ratio. Okay, this ideally should be around 70%. Okay, so the ratio of the body to the wick of this substantial candle, which is always the second candle in the fair value gap, the ratio should be around 70%. Okay, once you have identified the substantial candle, which is the second candle, okay, we now analyze the first candle and the third candle. Okay, so now we analyze the immediate preceding candles following the substantial candle, which is the second candle. Okay, so these neighboring candlesticks should not overlap the significant candle entirely. Okay, you see, the minor overlaps may occur on the upper side and on the lower side of this middle candle, which is the second candle. And we said that that is the substantial candle and it is the middle candle. Okay, then the fair value gap is the gap between the wick of these two neighboring candles. Okay, good. So we said there are two types of fair value gaps. We have a bullish fair value gap and a bearish fair value gap. Okay, so in other terms, the bullish fair value gap is also always referred as the overrated fair value gap. Okay, this is always referred to the overrated FVG. Okay, FVG. Okay, while the bearish fair value gap is always referred to us as the undervalued FVG. Okay, in a minute we are going to see why the bullish fair value gap is referred to as an overrated FVG, while a bearish fair value gap is referred to as the underrated FVG. Okay, so just from the name overrated and underrated, you can be able to guess their meaning. Okay, so if we start with the overrated fair value gap, this usually indicates that the price of the current pair of the currency pair or the financial asset is currently trading above. Okay, so this may indicate that the currency pair may be trading above, okay, its fair value. Okay, so we have another term, the fair value. This is where we get the word the fair value gap. Okay, so we may, from the bullish fair value gap, which means that it is an overrated fair value gap, it means that the price of the currency pair or the commodity or the stock or the underlying asset is trading above its fair value. Okay, good. So here, traders expect the price to come back to the fair value so that it corrects this imbalance. All right, so that it corrects the imbalance. Okay, it settles the inefficiency so that the market can be efficient. Efficiency so that the market can be able to be efficient again. Okay, so that the market should come back and do what? And sweep liquidity. Okay, so these three things are very important. Okay, on the other hand, we have undervalued FVG. Okay, this type of fair value gap suggests that the price of the currency pair, the price of the stock, or the price of the underlying financial asset is currently below. So the price here is currently what? Below. It is trading below its fair value. So its fair value may be here, okay? But now the price is trading below the fair value, and we expect and anticipate that the market will come back, retest, and take out the fair value and then continue to trade downwards. Okay? Always remember that the fair value gap often signals large institutional orders, indicating a very strong conviction in a particular direction. Okay, so if you get a bullish fair value gap, this is a very strong conviction of an uptrend. On the other hand, if you have a bearish fair value gap, that means very large institutional orders indicating a very strong conviction of a downtrend. Okay, good. So this gap that we see here, the bullish fair value gap and the bearish fair value gap, will always represent areas where the market has moved so fast because of this second substantial candle. Okay, it has moved so fast for the counter orders here below, okay, creating an imbalance here and a liquidity pool here. Okay, remember all these words are the same: liquidity void, liquidity pool, in market inefficiency, imbalance, and the fair value gap. Okay, so in this case, the price will act as a magnet. The price will act as a magnet. Uh, it is pulled by this inefficiency, okay, because there's some liquidity void here, okay. So the price will have a tendency to come back, return to these gaps to fill them, okay, to fill them. After filling them, if the market was inefficient, now after filling them, the market will be efficient again and it will return to its original direction, which was on a downtrend. In this case, it will continue with a uptrend. Okay, it will settle this imbalance and the market will be balanced again. Okay, it will sweep some liquidity and it will have enough power to continue pushing the trend either on the higher highs and higher lows on an uptrend, or to the lower lows and lower highs in a downtrend. Okay, these gap areas can act as future supports, like this can act as a future support in an uptrend, while in this case, this can act as a future resistance in a bearish trend. Okay, remember that it is very important to use these two type of fair value gaps in conjunction with other price action strategies like the supports, like the supply and demand zones, and you can also use the structural breaks in the market like the market structure shift and the break of structure. Okay, please note that while the price fills these gaps, as we can see, it is not a guarantee that these gaps will always be filled. Okay, so you must trade fair value gaps with caution. Okay, you must be able to determine whether the fair value gaps are valid or invalid. Okay, in an invalid case, the price may move through this fair value gap, come down, hit your stop losses that you have placed here, or the stop losses that you could have placed there, leading to significant losses in your account. Okay, good. There are fair value gaps that are formed during high impact news events, or those that may be formed in key trading sessions like the London or the New York kill zones. This type of fair value gaps, they carry more weight compared to other types of fair value gaps. Okay, good. So please note that once a fair value gap has been filled, it is no longer valid for trading as price has already revisited and traded through it. Okay, so what we mean, if the price has already mitigated this zone, it is not wise again to come on and trade on a retracement of that zone again, because it has already been filled. Okay, it has already been mitigated, it has been revisited, and it is no longer valid. Okay, note that once you have determined the trend, either an uptrend or a downtrend, the next step is identifying supply and demand zones. Okay, this supply and demand zones is what you will call an order blocks. Okay, so you must look for these supply and demand zones and order blocks that align with the with an uptrend in a case of bullish momentum, and those order blocks that align with a downtrend in case of a downtrend. Okay, so the simplest way to draw supply and demand zones in such cases is using the first candle that forms these fair value gaps. So what am I saying? In this case, that this is the first candle and this is the first candle that formed these fair value gaps. So we are going to take the high and the low of this candle, and this one now will form a demand zone, okay, or a demand zone, or a what? Or a bullish order block, okay? When you come here and you take the high of this first candle and the low of this candle, this one now forms the supply zone, which is what? A bearish order block. Okay, good. So you see, a fair value gap occurs where there is significant price differences between the close of one period and the opening of the next, signaling market inefficiencies. Okay, so you see the open of this candle and the close of this candle, the opening of this candle and the close of this candle, the opening of this candle and the close of that candle. Okay, so these disparities between the opening and the closing of this candle will always show us where the fair value gap will occur. So I'm going to share steps on how to quickly and easily identify the fair value gaps in your live charts so that you may be able to spot them quickly and trade them profitably. Okay, so if you were to look for this bearish fair value gap, what is the first step that you are required to look? First, if you look at this whiteboard, you can see that you first must look for three consecutive candlestick. One, two, three. Three consecutive candlestick. Okay, good. What is the next step? The next step is identifying the lowest wick of the first candlestick. Okay, so this is the second step, identifying the lowest wick of the first candlestick. All right, the next step is identifying the highest wick of the third candlestick. The next step is identifying the highest point of the third candlestick. Okay? Number four is to ensure that there is no overlap between these two weeks. Between these two, the first week and the second week, there is no overlap. Okay, where there is no overlap, there is a creation of a gap. Okay, and that gap will lie on the second candle, which we called it the significant candle. Okay, so here is our significant candle, the second candlestick. So the gap lies on the second candlestick. Okay, let us go to our bullish order block. To clearly and easily identify the bullish order block, we must have three consecutive candlesticks. One, two, three. Okay. The next step is to identify the highest wick of the first candle. Identify the highest wick of the first candle. All right. The next step is to identify the lowest wick of the third candle. Is to identify the lowest wick of the third candle. What is the next step? The next step is to make sure that in that structure, the two wicks, the wick of the first candle and the wick of the third candle, do not touch each other. Okay? Consequently, look that there is a gap creation on the second candlestick, which was our strong candlestick where there was strong price movement. In this case, there was very strong bullish momentum on that candlestick. Okay, so I believe that I have simplified the concept of fair value gap enough for you to digest easily. Okay, so by that we have reached to the end of our fair value gap class today. If you are watching this class from YouTube, kindly like, share, and subscribe to this channel so that you may get notified on our next class.